I'm a founder and managing director of Correlation Ventures. We're a $370 million venture fund. We invest broadly across all industry sectors, all stages around the country, so it's a broad mandate. I've been a VC for more than 20 years and also an entrepreneur raising venture capital and managing venture-funded companies, and just realized how time-consuming and distracting fundraising often is for management teams. And there's a trade-off, all the time spent raising money, managing investors is time that otherwise could have been spent getting your next customer or whatever. And when I was the lead investor in a round, or somebody else was, I do think important to be an industry expert, adding value with the board, doing classic due diligence, that's all important and vital. But once we got past one or two active VCs, in almost every company where I've been involved, the last thing anyone often really wanted or needed for the next investor was another VC board member. At that point, we often really wanted professional, reliable investor, provide capital quickly without all the hassles or distractions. And didn't think that existed, so founded Correlation to be the ideal co-investor to rapidly fill out a VC-led round. Specifically, we commit to make investment decisions within 2 weeks or less. Much more rapidly, of course, than other firms in the industry. We make these rapid decisions using predictive analytics. So in case you've seen Moneyball or read Moneyball, many people call us the Moneyball of venture capital. We simply request a handful of readily available documents. Don't repeat classic due diligence. We're highly flexible on investment size. We invest anywhere from 100,000 up to 3 million in initial investments, and up to 5 to 6 million over the life of the company. But we don't have a need to get a certain amount of capital to work, have a certain ownership percentage, so we're happy to slot in with whatever is helpful to finish the fundraise. We don't take board seats. We're often helpful to our companies. We're one of the most active VCs in the country. We make about 2 to 3 new investments a month. We have about 200 portfolio companies, so we make lots of introductions between portfolio companies. We make lots of introductions to other investors, since we co-invested with virtually every active VC in the country. And our predictive analytics team will often, kind of advise companies where predictive analytics is important. But we don't force ourselves into the mix and take a kind of a classic board seat. The one requirement we have as a co-investor with this unique offering is that there's at least one other financial VC who's also making their first investment in the company at the same time we do. So as soon as that condition is met, and assuming additional capital would still be helpful, then we'd love to consider an investment, and if so, we'd make a rapid decision. VCs will refer opportunities to us a lot, but also we have many calls with entrepreneurs even before they have a lead VC. So we have a call with entrepreneurs raising a venture round. We can often make suggestions on VCs they might want to reach out to who would be a good fits to lead their next round. But the time we can actually consider an investment and make a decision within 2 weeks is once they have at least one other financial VC who's committed to participate in that round. We're using an analytical model to make co-investment decisions, and it looks at lots of different variables. Things like, are the investors who are investing for the first time, is this, how experienced are they? How similar is this to other investments they've made before? Are they investing in their comfort zone? What's management's background and experience? What are the terms of this investment compared to similar companies, similar financing rounds that have occurred? What's the makeup of the board of directors? What have been the dynamics in that particular industry sector? But the model is it's tilting the odds, we believe, a little bit in our favor. It's not a magic crystal ball. It's really just a method to enable us to make rapid investment decisions, save entrepreneurs time and hassle, so they can focus instead on building their business rather than on going through yet one more rigorous diligence process. Studies have been done showing that the primary reason why a lead VC will invest in a particular company is that they trust the founder. More so than the business opportunity or the risk. So it's, as a key piece of advice for entrepreneurs, is to focus on establishing trust with that lead VC, and that means sharing good news, bad news, risk, concerns, plus upside. So it's that's my experience as an entrepreneur. both raising correlation ventures, but also raising venture-funded companies. That was what I found to be the key to a successful fundraising.